Wells Fargo's Chris Harvey urging investors to, quote, sell before May and go away, calling for a meaningful correction in stocks. That was, of course, before a couple of good back-to-back reads on inflation. Mr. Harvey is here with us on set to explain. Welcome.
Thank you, Scott.
I'm glad we finally corralled you, because when I saw this note, we were like, let's get Harvey. Our call, I'm quoting from your note, okay? We're within spitting distance of our 4,200 S&P target, now shifting direction. Expect a 10% correction in the next 3 to 6 months, a front-end inversion, a 7% year-to-date run, and a banking crisis that will likely take an economic toll triggered our reversal. And here we are. The market still looks like it wants to go higher. Dow's up 400 points. What say you?
What I say is the same thing I said before. We're going to have a correction. We're at 4,200. Our price target is 4,200. That's 20 times a 210 number. Those are both really, really healthy numbers. I can't get a bear case from this level. And what we expect is a pullback over the next 3-6 months, whether it's related to banks, whether it's related to the Fed, or whether it's related to multiples compressing. At the end of the day, the risk reward just does not look that attractive.
Yeah. What do you think this rally is about? Is it on a belief that, the so-called bad news that we've gotten on the, economic front, some of the Fed speak, they're just going to continue to do what they do. They're going to eventually put us into a recession. They're going to have to cut rates?
Yeah, Scott, typically when we have a tightening cycle and you get a pretty big rally, you get a 3% rally in 1 month, you can get upwards of 8% in 3 months. And I think that's what's going on. But if we're going to have the Fed cutting, something bad had to happen. And so we're in this sweet spot right now, but we're not going to stay there for very long.
What if the worst that was going to happen happened? What if somehow we actually have a soft landing? And it's not off the table.
No, Scott, it's not. So the bull case is, right, that rates go down, the Fed stops, we don't have a big recession, and, oh, by the way, you don't have to pay back your student loan. Okay, that's possible, but is that probable? I don't think that's probable. And our issue is, what kind of growth are we going to see in 2024? It's not going to be very much.
Do you think the Fed cuts this year?
We do think the Fed cuts this year.
How many times?
Gosh, I don't know, but what I can tell you is I think the Fed will have to cut more than they expect, because what we know is interest rates, or the economy, is not as interest rate sensitive as we thought, and regulation is coming down the pipe for banks.
If we have the pullback that you expect, how do you think we finish the year? I mean, do we, when they start to cut, do we rally back and we still have a decent year?
I think so. So we're not lowering our price target. So what we're expecting is a viable pullback. We think it's around 10%. We think you get to 3,700. But you're right. If the Fed does start cutting rates, then that's generally a good thing for a short period of time, and we can end up back at 4,200.
So you think 4,200? That's still your end of your target?
End of your target. Yeah.
Now earnings obviously hot and heavy tomorrow, starting in the morning. United Health, and then obviously the banks. Right. The market, you don't think, is priced in soft recession? I'm assuming at the level that we're at now for earnings, which are still around 220.
220. So what I think is happening is we're going to get multiple compression. The market's going to start to say, oh, wait a minute, we didn't think about this. And then we might have a little bit of, again, what we're having right here, right now, is euphoria around the Fed. The Fed's ending, rates are going lower, it's all good, we're going to have this soft landing. But we really have to deal with the reality. And the reality is we're at the end of the cycle, we're going to get a blip because of the SVB. And we had a banking crisis that never leads to more credit availability.
I know, but it was so idiosyncratic, you could make the argument that it doesn't necessarily have to be that next big cataclysmic event.
So here's the thing. We think tails you lose, heads you lose. Because if banks don't make financial conditions tighter, then the Fed will. So it doesn't matter what happens, because if the Fed says, hey, the banking situation's fine, they're going to tighten even more.
What do you think the banks have to say tomorrow? Is that sort of the first sort of thing that you think breaks this move?
I think the banks, the large cap banks, will actually do okay here. And I think what it is, it's the regional banks are going to have more problems.